Walking the dog right now. But this video is basically going to be about the importance of investing and how you're taught to not even consider what's going on macro environment wise or any impacts that could affect the trending stock prices and things. Now, I've been told to do these on YouTube because usually I just do them for a few people on voice notes and things just to pass the time. But the importance is crazy. Once you start to actually realize, that you're leaving so much money on the table. Like, for example, if you're just putting a few £100 or a few $100 to keep it universal into any form of market, whether it's a stock market, whether it's the bonds market, whether it's the crypto market, obviously looking forwards at least 5 years, there's not much that can go wrong. Yes, we've seen in the past where, as an example, a company, Intel, just this year has gone up over 100%, whereas since the bubble in the early 2000s, it's taken 25 years for them to reach their peak, which is extraordinary. But yes, there are exceptions that can happen like that, so it's imperative that you do keep that in mind when investing in any stock or any index fund. But it's still better to prioritize putting at least a few $100 every single month, if you can, into your Roth, into your ISA, because on those gains in the next 10 years time, you don't want to be 10 years into the future and then look back and think, if I did just put $400 every single month into the S&P 500, which right now is only about 3% off its peak from its May high. So, and you might think, what's the importance of that? Well, high growth stocks have currently experienced their worst month in history. So, and that's a fact from Goldman Sachs. Goldman Sachs has literally said that their high beta stocks, which are stocks that trade, if, for example, the S&P 500 trades 1% down, these stocks might come down 3 times more. It trades at a 3 beta or a 2.5 beta or a 2 beta to the S&P. So the thing is, these stocks such as AI, semiconductor, AI infrastructure, energy, quantum stocks have fallen anywhere from 40% to 78% in the past 3.5 weeks. And that's not because the stocks have had any fundamentals change within the core businesses, but it's mainly because of risk being taken off from these assets. A lot of it could be due to the SpaceX IPO affecting the space sector. That's one thing. But it does present a lot of value as well. If you are looking to get into any of these stocks exposure-wise, when they were in their highs, memory stocks were soaring and they couldn't come down, it was euphoric. These are the times where you can get into a stock and be like, I'm getting in at a value where their revenue, their PE multiples are starting to make sense. And so there's always a pile of investors that feel more comfortable buying into these higher growth stocks if you're younger and you would like to take on a bit more risk because you're trying to grow a smaller pie. Or you could quite easily do the same thing with the S&P, with the QQQ. In my opinion, I would use the QQQ because it's more tech-based, but at the same time, it's not too important. The most important is just getting in and getting started. Like, if you're in the UK, you could invest in the FTSE. You can look at iShares. They have loads of different ETFs options available. They have global stocks. They have consumer staples. There's so many that you can put your money into. If you're looking for dividends, for example, if you've got 100 grand and you want to put into dividends, there's specific dividend ETFs that if you put in, like there's one, JEPQ, I believe it's, I'm not going to say the company that it's related to, because I might be wrong, but I believe it pays between an 8 and 12% dividend per year, and it has been doing that consistently. And you might think it's a bit too good to be true. Well, they do it because they sell options on the money deposited. So if you're investing 100 grand into the company, they're going to use that money to do covered calls on. So a covered call is basically where you're investing your own capital into a stock. Let's say I bought $100,000 worth of Apple. at $100 per share, keeping it simple. A covered call is me basically saying I'm capping my upside potential. So I'll say to the broker, hey, Mr. Broker, my shares of Apple I am more than happy to sell my shares of Apple at $110, and they will pay me for that. They will give me money just to say that I'm happy selling my Apple at a profit, at a $10 profit per share. So you can see how good that is, how too good to be true it seems. In hindsight, my arm's getting tired. However, that is actual strategy, and that is actually how these people are making it work in the market. And it's a strategy I use myself on my own brokerage account, and it's a strategy that a lot of people use themselves in their own brokerage account as well, just to increase their cash pile, increase their cushion. So when stocks do fall, guess what? They've got a buffer. They've got a bit of a bigger cash pile to actually deploy into the market. And yeah, it's called the JEPQ, or they got JEPI is another one. There's a few other ones as well that do pay dividends. A quick Google search will help you guys with that. But yeah, I just thought, you know what, I'll do this for YouTube because I walk my dog every day. So this could be a regular occurrence of me just talking about things. But it is a shame that a lot of people aren't actually investing more into their own future and investment accounts when they could. There's always government incentives as well, and they're always there. They're not going to go anywhere, because at the end of the day, to invest in stocks is always going to help the overall economy. It's going to give the stocks a bit of a boost, a bigger cash pile, bigger valuation. How will they leverage that valuation? Well, they can take money out from their own company because at different value. I look at Jeff Bezos, his rocket company, Blue Origin. They're raising $10 billion right now at I think it's at $100 and something billion valuation. $130 billion valuation it could be. But that's a very good valuation. And you do have to be an accredited investor in order to actually get access towards his company. But it shows you that space sector is not going to slow down. And majority of space stocks are down from anywhere from 50 to 80% in 3 weeks. Does that seem overblown? It seems overblown to me. So it's one of those where you can either dip your head in the sand and think, oh, stock market's collapsed, it's not really going to come back anytime soon. Or you can look at it as a potential to actually get invested into the market at a time where it's one of the best entry points. Because like I said, a majority has bought at the highs, going up to the highs. You have to remember that hedge funds have not yet deployed a lot of their capital. Right now, hedge funds are sitting on some of the biggest cash reserves ever in history. They have not deployed enough capital into the market. They are underperforming. And right now, where stocks are at their lowest, a lot of institutions, we call toots, they are still accumulating these stocks, such as AST Space Mobile, such as Rocket Lab, two space stocks that have high potential, but also higher risk. Another stock I like is Nebius, which is currently one of the leaders in the data center space. There's a lot that you can look into. There's a lot of earnings happening right now as well. But like I said, if you don't want to be an investor where you have to pay attention to all these earnings, different cycles, what's happening in the data center market, what's happening in the AI infrastructure market, what's happening in the energy sector, is legislation changing? Is it making it more harder to get access to the grid, which will obviously impact energy, which will obviously impact data centers, which will obviously impact AI infrastructure, which will obviously impact memory stocks because there'll be less demand for GPUs and things. I don't know. But if you don't want to be an investor that has to focus on all these things, then you know yourself that you want to be a passive investor. And if you want to be a passive investor, then you should just put a few $100s into the QQQ or the SPY, let it sit there, let it grow for you, doing absolutely nothing. Because you don't want lifestyle inflation to start digging away at your money, because that's just going to cause you to just not realize the gains that you could have had. And compounding is a big thing. if you're compounding $10,000 every single year of cash you have in your pocket, you can quite easily multiply that to the hundreds of thousands. If you continuously deposit $10,000 every single year into one ETF index fund and allow it to do its thing, just give it time and you'll see just how fast it will grow. Because it's not a matter of if, it's a matter of when. And time in the market is the hardest thing to replicate or get back, because there's always a need for money. There's always a need to take some money out. So if you put some money in that you can afford to keep putting in, that habit will grow exponentially. I can do these videos every single day, so do hit all the buttons and comment your thoughts down below, because like I said, I do this all the time anyway, in private. If any of you found it useful, then please let me know, and I'll see you tomorrow or the day after.